Ladies, gentlemen, welcome passive income investors alike. Today I'm doing something by popular demand, which is revealing exactly what my tax-free savings account and my other investment accounts look like and how much I'm making exactly in dividends. I've recently watched, the Monk Way, Graham, Stefan, Dividend Grinder, all of these beautiful YouTubers have been revealing their portfolios, and I think it's going to be a very healthy and educational experience for everyone. And I'm not using this as some kind of bragging rights. I'm using this strictly for educational purposes, guys, and I'm hoping we can learn from each other, and especially because a lot of people don't show what these accounts look like or how they function. We're going to be doing this through Scotia iTrade. It is my investment platform, guys, and we're just going to generally hop right into this. I'm going to go over the positions in my TFSA first, and then we're going to look at the performance and the dividends, and then we're going to move over into my other account and do the same thing. So really quickly, guys, I have currently a capital gain of $801. I was up over 1,000 today. I actually have a way higher capital gain than that. I'll explain more about that in a little bit, because you'll notice my contribution limit is much higher than a TFSA allows. As of 2019, I think you're allowed to self-contribute about $61,000, and I'll explain why this has happened. You get this through capital gains because you can't contribute this amount without penalties, and I've had dividends come in lately, so I'm sitting on 238 in cash. But let's look at the positions, guys. Apple is one that I'm sure we all love and own. Many people have this in their portfolio. I was up almost $20,000 on this position not even that long ago. If we look at the chart, guys, I was like killing it up in here, is where I should have maybe sold off a little bit of it, and I didn't, and then we've seen this big decline, bringing me back down to pretty much what I purchased it at on average, which is about $170 per share. Long term, though, not too worried about it, guys. Down small percentage on it. I wish I could organize these in a way that would make it a little easier to line them up, so I could do like tech first and then banks and then everything else. It's gonna be a little scattered, but we'll go one at a time. So now looking at Bank of Nova Scotia, you'll notice there's a little drip signal here, guys. That means that the dividends I make on this company are getting reinvested back into the bank, which I'm sure they love, but it's increasing my dividends. I have a huge position on this. By the way, Apple's one of my largest, my top 3 holdings. Bank of Nova Scotia is another really large one. I'm down $26, not much. I have an average buy price of 75 on it. The banks have had a real good bull rating lately, so they've been coming back with a vengeance. Over time, this company has good equity growth, but I'm more or less in it for this crazy high dividend yield, which I love because it's consistently been able to pay that out with no problems in the past. That's why I love the banks. Like my mom says, if the banks go broke, the money in your pocket probably just as worthless. You'll probably be more worried about food and water at that point. So I love the banks, guys, for dividends, especially Canadian banks. Next in line is Brookfield Real Estate Services. I've talked about this in the past. I don't like this company. It's my least favorite company in my entire stock portfolio. Essentially, they're just realtors, pays out an insane dividend yield, and this dividend yield is based off royalties. It's a very reliable dividend yield. I'm planning on selling this in the not-too-distant future. I'm just holding on to it at hopes that it has a decent rally back here because now that the housing market's kind of come back a little bit after this cooling off. The reason I got into it at such a high price, as you'll notice, over time, this company has done nothing but go up over the last 5 years, and I got tired of it right around here. So I started buying it, and I bought all the way up into the 20s, guys, giving me an average buy price of about $18. And then it tanked when the Canadian housing market kind of had a cooling because it hit a peak, and now it's slowly coming back. I don't mind it because I think the dividend's reliable, but I really want to get rid of it to buy more of GEO Group, which I'll get into in a second. But let's look at the other bank that I own here, and that is Canadian Imperial Bank, and it's one of my largest holdings as well at an average contribution here, a total of $16,359. I'm down $300 on this position. Not that I care because of this whopping 4.8% dividend yield, guys. Super healthy. Super awesome dividend yield. Again, all the banks have a really good bull rating on them right now, and this has been one of the best performing banks of all time, guys, just because of that dividend yield. So I'm happy that I'm getting a good drip on this, and again, we'll get into the actual yields themselves and how much I'm making in a sec. GEO Group, if you don't know what that is a prison stock. They own most of the correctional institutions and prisons in the U.S., along with global positions as well, guys. I love this company, so I'm thinking about selling more of this to buy more of this, because this company, over the last 5 years, the equity hasn't done much, as you can see, but the dividend yield has been insane, absolutely absurd, guys. And I think it's just a really stable company. I don't think it's going anywhere anytime soon. It's been around in public since the 80s. Us taxpayers pay for the beds. In my opinion, it's like a REIT that is just not a REIT, so you don't have to deal with the tax implications that come with that, and you get that kind of REIT aspect return. Again, I wish I had a bigger chart, but I'm not going to get into those. I have to go into another part of this account. But again, this company, I like it a lot. It's going to be, I think, one of my bigger holdings in the future. Now, looking at Microsoft, we all know what Microsoft is. I'm holding this with Apple just as growth stocks in my portfolio here. I'm up on this position, but I think everyone's pretty much up on this unless you were buying it at the highs. If you're buying at the highs and you didn't buy on any of the dips, you're a little silly. This company's been giving a lot of good buying opportunities lately. I bought it all the way back around here when it was just hitting the 100s, and I've watched it go up a lot. I've watched it come down. I've watched it go up. I've watched it come down, and now I'm watching it go back up. Meanwhile, I collect my 1.7% dividend yield. I still like this company a lot. Plan on holding on to it for a while. No rush on getting rid of it. Which brings me to one of my favorite companies of all time, guys. Northland Power. Oh, man, this company is doing so much with natural energy. Beautiful company, super well ran. This was one of the first companies I've ever bought. I was up $1,000 on this position in the past. I had to sell out of it to move the money into my tax-free savings account, where I have rebought it at an average buy of 23.35. And if we look at the chart, very healthy return over the 5 years with a super awesome dividend yield. One of my favorite companies of all time. I'm thinking about buying into some more utilities, but I'm going to do an individual video on this one, maybe today. Just because I like it so much. And we all know Southern Company is a big utility in the U.S. I've been averaging into this over time, and I've been buying it on the dips. I bought it twice so far. So if we take a look at the 5 year, when it made this major dip downwards, I was buying it in this area, came back up. On the second dip, I bought more down in this area, and now we're back up quite substantially and seeing a very healthy return buying those dips, guys. I like this company. I think I'm going to get an insanely good return this year, considering it pays out a whopping 5% dividend yield. I think I got that set up over here. So let's just take a quick look at the performance, guys, of this account and how it's done. And this is a pretty new account. As you can see, I only opened it of July of 2017, and we're only in July of 2019. It's almost been 2 years for this account, and the return has been a whopping 52.55%. At the peak, it was sitting at around 70, but you know, when Apple tanked, all the banks came down. 2018 was a bit of a rough year, as we can clearly see, as a lot of my stocks came down, but we're slowly popping up. But over 2 years to get a 52% return is pretty insane, guys, and I don't think I'm going to have that kind of performance in the future. It was strictly because of a company called Canopy Growth Corp, a marijuana company that I bought into. I bought 1,000 shares, and I turned 8,000 into 30, and that's why this has been up so much. As you can clearly see, my rate of return over time down in this little charting section over here, guys. Looks very healthy. Very happy with this account. So let's move into the thing you've all been waiting for, the dividends, guys. This is my favorite part of anybody's portfolio, I'm sure, is the dividend income. You can see Northland Power, my favorite company, pays a monthly dividend. I currently make over $800 a year on this company, paid out again monthly, and the next dividend payment's March 15th. I love the setup in this account and how it shows you how all of this stuff works. So I scroll up a bit, you'll notice it actually tells me the months and what I'm getting paid in those months, and obviously the reinvested is the drip, and the money that can't be dripped is just getting paid out. And you'll see all of these positions, guys, my reinvested cash flow and the cash income that will happen this year, or the estimated cash income that'll happen. This makes me so happy because this is the definition of pure passive income, in my opinion. You can see these positions and what exactly they are doing. I love how this works. It's the definition of true passive income. I'm not going to sit on this for too long, just so I don't take up too much of your time. I want to get into my other account really quickly, guys. But if you want to see how dividends work, this gives you a really good idea. I love how they project this out. The Bank of Nova Scotia does a really good job on Scotia iTrade at really managing your dividends. All right, let's break down my last account here, guys. Now, like I said, in my other account, the contribution limit is higher than what you're usually allowed to add of $61,000. I'm sitting at around 80, and that's because of Canopy Growth Corp. And if you can get that to happen, that's why you want to put usually some of your higher growth stocks in your TFSA, guys. So when you do decide to liquidate them, you're going to be able to buy more dividend stocks and get a higher dividend return tax-free. Now, this is my higher risk account, in my opinion. This is where I buy stocks that I'm a little hesitant on. as I don't want them to I don't want them to screw with my TFSA. I'd rather not get any capital losses in that account as much, or limit it as least as possible. Obviously, I got $226 in here. I just purchased some Constellation brand. I'll explain more about that in a minute. But let's look at these stocks in order here, guys, starting with Altria Group. I didn't scroll up too much. Let me scroll up a little bit and show you guys what this is looking like. Right now, I've got a book value of $27,000 on this account. I'm up $388. But MO, Altria Group, we all know Altria Group. If you don't know what that is, it is the best stock of all time. And what I mean by that is literally there hasn't been a stock, I think, in history of the stock market that has a rate of return as this company does. And essentially, when you look at it, it doesn't look like much. I talked about this recently in the past. But this company, it doesn't have to do with their equity growth, like this charting we see here. It has to do with their dividend growth. If you bought this company 10 years ago, your yield on cost is over 20%. That means your dividend yield is literally 20% plus a year, plus including your capital growth as well here, guys. So I had to buy some of this. It's been down way too much in my opinion, and they just bought into Cron, which is a marijuana company, and they also own some vape companies. They have shareholder in Juul, I do believe. I have an average buy price on that right now of around $46. Really happy with this position. Looking at Bank of Montreal, I added another bank stock to my bank portfolio, because bank stocks, guys, especially this bank stock in Canada, has been the best performing bank of all of the Canadian banks. I used to own Bank of America. I don't own any U.S. banks right now because I'm really focusing on this higher dividend yield. This has been a really well-ran bank, one of the best ones. So I had to add it to my buy list this year as well. So I picked up some of that with some of the precious metals I sold in my past videos. British American Tobacco, my best performing stock so far this year. I bought 100 shares at an average of 31. I have this stock I can't get over. It was trading at a PE of just under 2 when I bought it, almost base value, with a very healthy dividend yield, up 12% at the highs, guys. So, I mean, if this company can hold where it's holding right now and I make a 6 or 7% return on top of this 11%, I mean, damn, that's almost a 20% return this year just on this company alone. Constellation Brands is one of my favorite companies of all time right now. It is my only exposure to Canopy. Canopy made me a lot of money in the past. I think it's going to make me a lot of money in the future, but I'd rather make it with less volatility and get a dividend yield. And when you buy it through Canopy, guys, when you buy it through Constellation Brands, if you didn't know, Constellation owns 36, I think, percent of Canopy, somewhere around there. And if you look at what happened to Constellation Brands, they bought Canopy up here. Well, this is what their valuation was at, and then they tanked. And now right where they're down here, guys, if you minus this off their market cap, you're literally paying a valuation as if you were getting Canopy Growth Corp for free. Literally for free at these valuations. So I actually just bought some more this morning. I had $2,000 worth beforehand, and I bought another $1,500 worth this morning. I'm only down 2% on the position, but I like the dividend yield. It's literally like owning the marijuana markets and getting some dividends off them. And this company has had an absurd growth rate. It's doubled over the last 5 years, and I think they're going to be able to sustain this, guys. I think buying this company in this dip isn't going to do you any wrong in the short or the long term. So if you're going to buy this, I'd be buying it now. I bought it in the past and I've traded it for profit. I bought it in the low 200, sold in the 220 area, and now that it's tanked back down, I am buying right back into it, guys. I love this company. It's one of my favorites. Facebook, we all know, I told you in the past, this is where I've been parking my tax money. This is just some of the taxes that I owe. I do owe a lot more than this, but I have money sitting in my basic account that I'm not messing around with, but I couldn't help myself. And I was actually up quite a bit on this position not that long ago, but Facebook hasn't been keeping up with the rest of the markets recently. Let's take a quick look at their chart. So when I was getting into this, let's take a look here, guys. So it was coming down, 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 and I started buying right around here at that 160 mark, and then it came all the way down to here, and now we're starting to see this this nice rally back, which I'm very happy for, because soon I'm going to have to liquidate this, and I'm hoping I'm not going to have to liquidate it at a loss, though if that is the case, then it is what it is. It's the risk that I took. So we all know about Tesla, guys. We all know Tesla stock. If you don't own it, you probably shouldn't. I'm not going to recommend this one for anybody. I'm just holding this as just something fun for now. I'm thinking about selling it to buy into some more Constellation. I feel like this company is going to have a better return. These positions right now are really small, in my opinion. A $3,000 position in a stock doesn't give me the movements that I like. I like getting it up to that 5K starting mark and then trying to get it closer to 10 over time. This probably sounds like a lot of money to you. If it is, I'm sorry. I know I started with like $500, guys. I don't know what else to say. I'm not trying to brag here. This has taken me years to build up, and I just keep dumping every dime I make into these pretty much, aside from the stuff I need to buy for my work. I don't go out to dinner very often, and when we do go out for dinner, guys, we're looking at discount places, anything that's on a deal, just because I'm young and I want to get this up as much as humanly possible in the short term. So I don't own a lot of this. Like I said, I might sell it at a loss. I'll let you guys know if I decide to do that. I don't really care for Tesla that much. It's so much fun to watch Elon Musk talk and things like that, guys. It's a really fascinating thing to see and get involved with and be able to watch Tesla do its things. But honestly, this company's really priced in for their future. They have so much to do before they can even reach their current valuation. And there's no PE on it because they're obviously not profitable, I think, as a company yet, which isn't that great. But I honestly think if I put all this money in Constellation Brands, I'm going to get one heck of a really understood return over time, and I'm going to get that dividend yield while I wait, which is what I like. But let's move into the performance of this account. This account was the first account I've ever opened back in 2015, guys, and you're going to see a really rocky ride. My accounts, believe it or not, were down 40% at one point. But again, we're talking about dollar amount here, guys. I only had $500 in this account, so when I was buying stocks and selling them and they drop in half or paying commissions, you'd really see a big dip. And I mean, again, when you look at this, you'd be like, damn, you lost almost half your money at one point. Yes, but half of my money was like $500 or $1,000. If I lost half my money now, it'd be a little different. Let's be real. But not being an idiot and learning and playing stocks, I progressively learned, because you can see from January of 15 to literally January of 16, I made no money. This was just me learning. This straight learning curve right here, guys. And then I started figuring things out. I started learning a lot more, and before you knew it, I started seeing some returns, and boom, I doubled my money in this account. And this was right around the time I realized what a TFSA was, and I sold out of this all my positions right around here, and I transferred them into my tax-free savings account after, again, I pretty much almost doubled, not doubled, but I had my accounts up 50%. And then back here, when I maxed my tax-free savings account, I started reinvesting capital back into this account, guys. And you can see, since I've been reinvesting capital, buying things like BTI, I've seen quite a nice return. So this account has seen at its highest peak, just like my other one, 71% return in a very short period of time, guys. Again, 15 to 19. This has only been 4 years. So I mean, realistically, you like to see your money double, what, every 10 years. So I mean, this is on track, and it's doing very healthy considering there was no money in this account and it flatlined for the longest time. But very healthy charts. You can see down here, guys, where I've lost money, and I like the fact that it shows you year over year, month over month, what those positions were like. You can see where it went green, and there hasn't been negative since. So I love all of this, guys. So let's jump into the dividends real quick, which is the stuff I'm sure you care most about. These dividends are only going to just start coming in now because I didn't own a lot of them before the ex-dividend date, including like BTI, $18,000 sitting here at a whopping like, the return on this is so healthy, guys. Seeing that $1,000 coming off just these 4 companies is really healthy, in my opinion, especially at the rates I was buying into them. You can see BTI 7.6%, MO 6.6%, STZ 1.7%, BMO 4.3%. Insanely healthy dividend yields. I'm going to set these up on a drip. I don't know why I don't have them set up on a drip yet. Can't do that with Constellation. Don't make enough. $62, not that big of a deal compared to these guys. But let me know what you guys think in the comments section below. Do you have a dividend portfolio? What do you think of my dividend portfolio? Is there any stocks on here you would own? Maybe you wouldn't own. I know this has been a long video. I hope you've enjoyed it. This has been a very educational thing for me. It's been a learning curve as I've been going along. Again, guys, I started off with $500, and you can see what consistency, patience, and determinism can turn into. Now I make enough money to basically give myself a really awesome free trip every year or pay a couple months worth of rent. Let's be real. This is a really nice, healthy dividend portfolio, guys. I'm going to finish it up here, not take too much more of your time. Stay cool, stay awesome, and I'll see you guys tomorrow.